G'day expats and welcome to another episode of Expat Chat, episode 102. Gosh, we're getting up there. Can't wait till we approach that 200 mark. As always, I'm joined with my co-host, the managing and founding director of the Atlas Wealth Group, Brett Evans, who is over in the Middle East, or in the sandpit as we love to call it. Brett, how are you going?
In the wet sandpit at the moment. We've got a bit of rain going on, so rain is nice, but also too, this place does not cope with rain. So inshallah, we get through this one with no too many dramas, but no, in this place, you never know what to expect. So you go with the eyes open. For the folks out there, we love to waffle on about the weather. So let's change the subject and let's introduce my co-host and mate, James Ridley, who's the managing director for the Asia Pacific region and runs the Australian office. G'day, mate.
G'day and welcome to those who are joining us today. We're going to talk about a really good topic, and it's come from a couple of case studies, but we're going to talk it more general today. I might give an example, but just in general talking about timing certain events, whether it's when you're first leaving Australia, becoming an expat, or repatriating, and when you should be actioning certain things. We're not going to get too nitty and gritty because obviously that's pretty hard when we've got clients in over 45 countries, and all those different events could be very unique and specific. But before we jump into it, I'll hand it back to Brett to do the little disclaimer.
Mate, all the information that we're going to imbibe and share with you good folk out there today should be treated as information and educational purposes only. Please do not construe this information as personal advice. If you do need personal advice, talk to specialists, talk to us.
Let's jump into it. Now, timing. I guess when we first are moving overseas and becoming an Australian expat, and I guess our formal definition of an Australian expat is someone that becomes a non-resident of Australia, a non-resident for tax purposes. And, I'm sure we'll know more about the tax residency rules changes that are forthcoming in the next, I'm going to say 4 months. But I want to talk about when certain events or transactions need to be taken into consideration. I guess one of the main ones, especially when you are leaving overseas, is, the deemed disposal event, or more recently, whether you're deferring capital gains, doing a deemed deferral. That's a really unique one. And often we don't see too many people opting in deemed deferral. Deemed deferral just refers to if you're holding, say, a share portfolio, something which is ordinarily treated as non-taxable by the ATO, non-TAP. Deemed deferring means you're not actually opting into deemed disposal. You're going to continue to hold it, but it does cause all these key risks and disadvantages whilst you're overseas. And some of them are your tax rate now goes to non-resident tax rate. So, if you're going to hold that portfolio for another 2 years, you do not get to discount the capital gains for the period that it's overseas. You held it overseas. Plus, your tax rate now is 32.5%, and then 37%, and then 45%. You get the discount the period that you held it as an ordinary Australian tax resident. That's okay, but you're now causing yourself more tax, I suppose, or a larger tax liability in the event you don't often opt into it and you do a deemed deferred event. I mean, Brett, pretty rare that I see people doing that. What about yourself?
The only time I've seen it really worked, executed and worked quite well was client was going overseas, had a share portfolio, wasn't sure what time frame they were going overseas for. So There's a nice little, I wouldn't say loophole because that implies illegal stuff, but a nice little trapdoor that you can sort of fall through quite well. As you leave the country. So everyone knows when you do your tax returns, they must be lodged by the 31st of October every year. This client wasn't sure whether it was worthwhile going through the deemed disposal exercise if they were only going to be overseas for a relatively short amount of time, 1 to 2 years. So if you think about this, and we'll call him Joe Bloggs. So Joe Bloggs left the country in December 2022. Now, his tax return is due for the 2022-23 financial year up until 31st of October this year. However, if you are engaged with a registered tax agent with the ATO, that return is not due till, was it March? I think it's March the following year.
It is March, you're right. But the registered accountant they have their monthly list that they need to submit to the the ATO, and then they can request extensions. Often, if you're not on one of the lists, though, usually you get a letter from the ATO, which usually goes through your MyGov ATO portal, sort of, requesting, hey, where's your tax return? There can be fines that can apply, especially if you're the type of person where you've always got a tax liability owing to the ATO. Quick shout out to our tax director, Ben Turner at Atlas Tax. He's one, obviously, that knows this off the back of his hand. But yes, usually it's March, but it can be pushed out. But I mean, it's still amazing how many people that are overseas and they've got assets, accruing income, and they just haven't done a tax return for several years, including those with hexes as well, hex debts.
No, totally agree, mate. Totally agree. So what we did with this client was, if you think about it, say he left in December 2022.
Mm-hmm.
It's now October 2023. His tax return is not due because he's engaged an accountant until March the following year at the earliest. As you say, you can extend it out, but let's call it March. So essentially, at that point, he, after 15 months of being overseas, he knows whether he's going to keep going or not. So he can essentially go back in time and say, okay, no, I'm going to be overseas for 3 to 5 years. I do want to do demosposal, or I'm going to come back in the next 6 months. It's not worthwhile. So that's a good thing about timing in terms of working with specialists who do this stuff on a daily basis. Is that's part of our mental gymnastics that go through our head when we're doing this sort of stuff, this planning, because the last thing you want to do is crystallize a capital gain and suddenly back in Australia. Yeah, okay, you've reset the cost basis, but technically you haven't had to do it if you didn't want to. So that's just an example of almost deferring that demosposal period that has worked really well for clients.
Yeah, absolutely. And I think another, I suppose, topic under timing is, and we talk about it a lot, it's our clients that reside overseas and where they're accumulating, a large amount of cash savings in their current currency, which is the foreign currency from Australia, and then choosing to send it all back when they decide to repatriate, leaving themselves open to a huge amount of currency risk. Look at the Australian dollar right now versus the US dollar. I'd say the Australian dollar, it's weak. There's a few factors going into it. Commodities aren't helping, the widening gap between our central banks and everything else going on from a geopolitical standpoint. Really good time to be sending money back to Australia if you're, I suppose, in a country which has that tether. Obviously the Middle East, you've got the US dollar and a lot of others, Hong Kong, those sort of things. So that's a really important one. But then also, timing, dollar cost averaging, spreading, it over the life of you being overseas is really important. But then also, timing certain events when you're deciding to come back to Australia. If you're trying to, I suppose, do everything 3 or 4 months out before you repatriate, I would say you're doing it all wrong. No, not at all. And I mean, you're leaving yourself open to a potential tax liability on the Australian side, depending on the kind of asset or type of investment that you're pulling out. A really common one's probably foreign pensions. We look at how they're treated in Australia. Section 99 Bs, the distributions. Typically, when you break down a Section 99B distribution, regardless of when you've returned and residency, that can sometimes open you up to tax liability on the withdrawal of that. If you're a tax resident and you're withdrawing it, so if you're an Australian tax resident and you're withdrawing it, it's going to be taxed by the ATO, 100%. No way to avoid that. If you're going to be withdrawing it when you're a non-resident, it should be a much better outcome. If you're withdrawing it in a year that you're not actually coming back to Australia, even better. So that's a really important one in terms of timing.
It's a good one because So I was just going to elaborate a bit further on that, especially for the folks on the podcast who based in the UAE with the new end of service benefit changes. So those who work for Emirates, Qatar, Cathay should hopefully be aware of the provident funds and the complications that go with it and the timing. But as a general population in the UAE, they wouldn't be aware of this. And essentially, Ben and I will be running through this in our tax and finance briefing webinar, which will be happening early next month. Next week, isn't it? It's scary. And I'll put the link below to that webinar. What it means is if you are crystallizing a gain in the same financial year as your return, that's where tax is assessable. So doing stuff, if you got to go back to Australia in December, which is a common time frame because kids want to line up with the new school year and that sort of stuff, and say April, May, that's happening, then what it makes sense is to actually convert the investments inside of that provident fund or end of service benefit, which is going to change into like a foreign pension, but it's not. Convert it to cash, crystallize all the gains in that period, pre-30 June, and then just hold cash from June through to December. Then that way, when you come into the country, you're pulling cash out. You're not crystallizing gains, and suddenly that's the way you can sidestep those little boogeymen. So that's a good example of even planning 6 to 12 months out, how timing is everything. It can make a difference of thousands, tens of thousands.
And I mean, timing drills down to, asset migration. When you think about if you're, building up a share portfolio whilst you're overseas, great, tax-free, very sensible. Be mindful of PFIX if you're in the US. But then when it comes time to repatriate, are you going to keep that as is? Or are you going to get super strategic here and consider another entity, such as, a family trust or a company, seek tax advice around that? And then, are you on the kind of platform that allows you to asset transfer or in-specie transfer that into the trust? And what does that do? Does it reset the cost base, going forward? And what are you actually going to be doing with that vehicle? So timing's everything. If you do that after you've actually returned from Australia and you've been in Australia for a year or two, cool. You've held the asset now for 2 years. It's taxable by the ATO. So you're actually going to be forcing yourself to cop capital gains tax on ideally, the growth of that asset. So being mindful of that, and that's why timing is really critical. I think another one is the timing of certain events. A really good example, and I was talking about it to Brett before the call, just an example case study is if you're in the kind of role where you're either in receiving employee share options or ISOs, NSOs if you're in the US, when is the right time to exercise them? Should you be exercising them whilst you're still in the US versus should you be exercising them when you're in Australia? Australia or the ATO doesn't prorata the period of residency based on, your ownership. So if I've held ISOs for 10 years as a non-resident and then I exercise them the first year that I'm back in Australia, doesn't matter. It's actually based on, the discount that you're getting. That's all treated as income. That's exactly right. There is some confusion around that, but it's crystal clear. The ATO will get to essentially tax you on that complete difference, the exercise price versus, what the market price is. That's treated as ordinary income in that year back in Australia. So if you consider an example recently that we've helped with a client, they wanted to exercise them all back when they were in Australia. We using one of our tax referrals over in the US, we calculated what that tax event would be in the US versus in Australia. In Australia, their tax bill, and I'm not going to go into the size of their portfolio, was going to be more than 250,000 tax versus if they exercise them in the US in the current calendar year and a little bit in next year, they're only going to pay, on average, about 110,000 Aussie. So you can see the huge amount of tax savings through that example. It's because they're benefiting from, I guess, some alternative minimum tax that's playing into that, as well as the state that they're in the US doesn't actually levy state tax, so they're quite lucky, to be honest. But that was a really good outcome based on that strategy piece and doing, a bit of hard work there. So that's a really important one around timing. I'll just wait back until I get back to Australia, then I'll exercise them because that's when I want to use the proceeds to put down as a deposit or buy a home. No, that's a shit strategy. Do your research. Make sure, when it comes to timing, you're doing it the right manner because the result can save you hundreds of thousands in tax.
I'll give you 2 examples which just come to mind as you're talking about that, and both of these would apply, generally speaking, to most folks, and the other one to folks in the US. So the first one is, we talk about building up a non-taxable asset portfolio while you're overseas, no accrual of CGT with the ATO. The first thing people say is, but what about the country I live in? And it's like, what you do is you don't cash out that account until you're back in Australia as a tax resident. So if you're in, say, France or Germany or UK or United States, great example, if you're in California where the DTA doesn't extend to state levels, there's tax. So if you sold that portfolio went from $100,000 to $200,000 in growth. Obviously a good job in the performance side, but let's say that, then ATO wouldn't want to borrow it because it's non-taxable assets, but the country you reside in would want to borrow that. However, if you go back to Australia and then you have what's called deemed acquisition when you arrive, so that your cost basis is the price as of the date. Now you're a tax resident and then you can sell it like a month after. So you're only up for about a month's worth of capital gains or losses, depending on which way the market goes. You've now expunged yourself from your foreign tax residency. You're now a tax resident in Australia. The foreign jurisdiction, by and large, I'll put the cap because some jurisdictions are different, but generally speaking, won't want a piece of that. And, then you can avoid that tax and then only pay a small amount of tax in Australia. So the second one, which is certainly in relation to US-based clients with 401ks, a lot of folks go, and they're more younger than older. So they're nowhere near the 59 and a half, age bracket when it comes to being able to access your 401k. If you redeem it early, you'll pay, obviously, the penalty tax. So people go, I'll do it when I'm back in Australia. What they don't understand is the DTA, yes, it does extend between Australia and the United States, but the tax rate in Australia is higher than it is in the US. So Australia will recognise the tax you pay to the IRS when it comes to the penalties of redeeming it early. But then if you add that on top of your assessable income in Australia, you might be able to top marginal tax break and you pay tax on that one. So by redeeming it before you return to Australia is the better way. So, I think we've got the message through to the folks, demarcating and timing. If you want, some people are very visual. If you want to work out, and this is, I've done with a number of clients, and when we talk sort of numbers and everything through their head, but when I draw a very simple diagram, it makes sense. And what you do is you just do a line on the bottom, 2023, 2024, 2025, blah, 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 as far as out years you think you'll be overseas and returning to Australia. You draw a line when you left Australia. You draw a line when you think, you got to return. So let's say you think going overseas for 5 years. It doesn't really matter. That number can move. Don't be too hell-bent on that number, on that date. Up until that date, you just write down what you have to do planning up to that date. And that's as a resident, ceasing residency, becoming out of Australia. And then in the non-resident part, you write those dates. Okay, I'm going to come out in 2029 back to Australia after 6 years being overseas. Therefore, in 2028, I need to get my shit together. So doing it like that, then it's like watching paint dry. It's so simple and so easy and methodical. Every country has different calendar years from a financial year. So it's not too hard to just reverse engineer it backwards. As James said, don't leave it to 3 months out because it's going to be a shit show. It's going to be really quite messy, and then you got to, but that's okay with this country, but it doesn't work in the in the Australian tax year. If you start slowly planning this stuff 12 months out, as I said, it's like watching paint dry or grass grow. So, but mate, I think
absolutely.
I think we leave it there unless you've got anything further to add. I think we.
No, I 100% agree. As we both know, all countries have different nuances when it comes to timing events, and you just hit the nail on the head with the different tax years. And I think we could spend probably another 7 hours on this topic if we wanted to go through each country, to be honest. So
I think, but just remember the 5 Ps, mate. The 5 Ps. Yeah. Prior preparation prevents. Performance. Performance. I don't want Apple or Spotify to blackburn us on the swearing side, but prior preparation prevents piss poor performance, and it's true. All these things done early and often, good results happen. People go, "Wow, you must be a genius." No, I just planned it. It's got nothing to do with that mental aptitude or intelligence. It's just
we can spin that quote. I don't know who was. I feel like it was that one of those NFL coach choices over in the US. It was by failing to plan, we're planning to failure. Fail. Yeah,
that's true.
Yeah.
No, it's spot on. It's spot on. And expats, need to adult when they become an expat. Yeah, it's easy to bumble along as an Australian tax resident. There's not too many tripwires, and you might pay a bit of tax here, but it's the dumb thing. When you get overseas, the numbers count. The numbers count, and then you got 2 mouths to feed. You got your ATO, and then and they're competing, and they want your cash. So it's dancing between the two, navigating it, and sort of like see the sharks going through the bait ball. You should be the shark. Just go through and power through.
That's it. Don't fail to plan. All right, guys. Timing is everything.
Yeah. So, mate, I think we'll leave the good folks there. They're probably finishing their workout on the treadmill or arriving at work. So I think it's a good time to wrap it up. So, mate, good to catch up again, and we'll see you on episode 103.
Sounds good. Thanks, Brett. Thanks, guys.
Take it, mate.